Stocks are lower this morning, but bonds lower as well. The 10-year yield continuing its climb to the upside as the I word is now making its way through strategy notes and more. We're talking inflation with Ben Emons, Managing Director of Global Macro Strategy at Medley Global Advisors. So Ben, let's start off with kind of the short-term analysis here. This morning equities are lower. We've got the dollar also firm. We've got yields still moving to the upside despite a pullback in stocks. What does that tell you?
Hey Oliver, it tells me that the liquidity is a bit challenged at the moment, right? You saw, I think, yesterday in Bitcoin, which has become, I think, a good barometer of broad liquidity because there's so much money moving into the Bitcoin asset class that if you get a bit of withdrawal there, we touched, I think, 35,000 on Sunday. That told me that the market is getting ready for a week where maybe you're reaching a bit of the climax temporarily, at least for the reflation trade. That said, there's a lot of events this week that actually add to the inflation theme. And CPI data coming out, a speech by Clarida on the inflation framework. President-elect Biden will lay out his plans for fiscal stimulus. And we got earnings that are all about banks and cruise lines. So I think the inflation theme is not over. It's just, I think, put on hold. And I think there's a bit of a tension in the market at the moment. And why the dollar is up and yields are up and Bitcoin is down.
Ben, what's interesting is it seems to me that we have to understand that there's going to be complications to an improving economy, right? And a lot of it seems to center around rates and their ability to continue charting higher. Do you think that we can have sustained periods of lower stocks and higher rates, or will we still see those moments where big sell-offs put a bid back into the 10-year?
I think the big sell-off will definitely put a bit of a bid back in there because in the end, the stock market is a reflection of the outlook, the economy that continues to recover as we get out of the pandemic. And the expectations are very high of that this year because as the vaccine is now here, despite some logistic issues, it's going to get out there and there's going to be more political push to have it out there globally. So the expectation of the stock market will be, I think, very much about the recovery is in motion. It will continue. That would eventually lead to higher yields, but indeed could lead then also to a little bit of collision between stocks and bonds if yields were to rise a bit too fast. So I think on any kind of pullback on stocks, if it's material, let's say 10%, you'll probably see a bit in treasuries, but small pullbacks like today doesn't because of the reflation theme very much in play.
So Ben, where do you go to try and see and gauge how far the 10-year can move? If you look at inflation expectations right now, I mean, they've been steadily climbing off the lows. The chart looks like a lot else out there, but maybe picking up a little bit of momentum. You've got 2-year and 10-year inflation expectations here. What does this mean for the Fed and what we might start hearing from some of the commentary?
I think it's actually not too difficult to at least see the short-term target for the 10-year. If you take the level of 1.33%, that was the low that was made in 2012 during the height of that crisis, then in 2016 during the Brexit, and also during 2019 in the trade war. So I think that's your major resistance point to the upside. By the way, noting that when we went through the pandemic down, all the way down below 1%, we did blast through that 1.33% pretty easily. So it wasn't much of a support, but I think it will be a resistance point at least. And as you know that these inflation expectations are rising, interestingly how short-term expectations are about the same as the long-term expectations, which does tell you that the market very much look at that, the yield curve should continue to steepen and the yield should normalize at least back to those pre-crisis lows and then see where we settle out. So, and with that comes some messaging along. We already saw it on Friday. Purchases will continue all the way out into 2021 at the end of the year. That's, I think, somewhat preemptive language to not let a disorderly move in yields happen. So 1.33 on the upside for the 10-year.
Okay, and that would basically bring us back close to the move that we got in March, where we had that kind of snapback in the yield. So the 1.3% kind of being that shorter term target there. And in terms of ways to play this, there's ETFs that investors can use to kind of track this, whether it's through tips, inflation expectations, U.S. versus the world. What do you think is the best way, Ben, for someone to maybe doesn't have access to complex inflation products or bespoke products? I mean, what's kind of just the simplest way to get exposure to this reflation trade?
Yeah, and one it would be the ETFs because there's a TIPS ETF, that's the US inflation-linked bond market. There's also a global version of it. That's, I think, a good play too because it's a global reflation story given the way the pandemic is approached everywhere in the same way, monetary stimulus and fiscal stimulus and vaccines. And then you do want to take a look at, semiconductors, materials, freight. I think those are indices. You have big ETFs on those. I think you can all play that still as that is your reflationary background. At the same time, take also note of what actually is happening really in the market, right? There's the technological disruption happening. I think that's been part of the rally too. So people should also look at that. Like people are flocking to alternative assets, which includes Bitcoin, but also other related assets. So I think that too is part of that reflation story. You're coming out of a major shock, and there's also economic change, which is, in a way, what we call reflation.
Ben, the stock connections, you mentioned ways to get exposure to reflation through things like semiconductors, some of the industrial aspects of the stock market. So it's not just the banks, it's not just the direct yield curve plays.
Yeah, it's not directly all just yield curve inflation expectations because, as you say, the materials and industrials are an interesting dynamic at the moment. Typically, yes, in an upturn, you see materials improve because there's demand for commodities and energy, but it's also to do, I think, a lot with the supply chain where countries really have to import a significant amount to, materials and so forth to support their economies getting through this pandemic. And that will still take some time, right? It's just not going to be over in the next few weeks. It's going to take probably the balance of 2021 before we can conclude that the pandemic may be really in a different stage than where we are now. And I think lastly, it's also about just the fact that the economy had done actually well throughout this pandemic because of technology that's done, has supported so well. Underneath remains the true recovery story, which is, of course, the leisure hospitality sector that got hit so hard. If you listen carefully to President-elect Biden, it has become now a policy target, right? The stimulus that will follow once he gets in office will be particularly directed at leisure hospitality and small business. I think you want to take advantage of that as well.
Ben, we've got, to your point on the calendar, a busy week for a lot of this theme and this subject of economic recovery, improvement, the data, the central banks, but the expectations that the president-elect will get into some of the details, as he said this Thursday, right, about what's going to be in this potential multi-trillion-dollar plan. For the most part, the consensus view is that nothing's going to stop the dollar from going lower, Ben. But I'm starting to think that maybe this market has priced in the cost of stimulus, but perhaps not the effects of stimulus. So, is it possible that we could get a report on the spending plan that is actually dollar positive? Because we know how much it's going to be, right? I mean, the market's got to be adequately pricing in a couple trillion at this point, months of talking about it. Is it possible that once we see the details, we'll go, you know what? This thing is actually amazing. It's growth positive, and it's going to be U.S. economic positive more than anywhere else in the world. So maybe the dollar can stop selling. I mean, is that a possibility?
I think it's a really important point, Oliver, because so far the dollar weakness has been actually caused by, one, the yuan being really strong because China has been so well positioned to weather the pandemic. Then the Asia-Pacific currencies, which are related to China, that have supported the supply chain and what the US relies so much on. And then Europe got some traction too because of their stimulus plan that came into effect a bit quicker than ours, let's say the big stimulus plan. Unlike the bridge that we have done here. And so, yes, this stimulus plan that is going to be outlined, people take a look at it saying, we're not just going to have a bridge in place to get just people past the pandemic, and we're going to get a real road to recovery, to rebuilding, as Biden himself says so, which does mean that we may get an economy that could stay at 4% growth or so for a number of quarters, if not into 2022. And that realization will underpin the dollar because, as we previously discussed, it would normalize yields because we're going to take out not just 1.33, but back to 1.9 or higher, because that's all, when the pandemic really hit. And at the same time, the economy gets on a sustainable track. that's a dollar positive story. And maybe this is a tentative bottom that we're seeing today. In addition to that, of course, the second, third, fourth waves of the virus are affecting countries currently negatively. Take South Africa, one of the worst performing currencies against the dollar. That too gives a bit of a lift to the dollar.
Interesting. So maybe some kind of changing, winds as they've been blowing definitely in a negative dollar way. Maybe this is kind of the beginning of retooling our expectations for the economy, and maybe we get some stability here. And as you mentioned, there are also 10-year yields that 1.3% of the short term, but if we're talking real sustainable growth, maybe back to some of those pre-COVID levels in year two. Ben Emons, thanks as always for the charts. Thanks as always for the analysis. He's a managing director of global macro strategy at Medley Global Advisor.